Hello and good morning from New York and good afternoon from Brussels. My name is Bart van Ark and I'm Chief Economist at the Conference Board, and welcome to this monthly series Window On, which this month is going to be focused on the window on 2017 Tax Reform and Reconciliation Act, that is officially called, or in short, quite often the Tax Cuts and Jobs Act. So thank you for joining. We're going to talk today, of course, about what our first impressions are of the impact of the US tax plan on the economy, on US businesses, but we're also definitely going to talk about what it means for the rest of the world. As always, Window On is a program that is really very widely attended around the world, so we really want to look also at sort of the global implications. So some of the key areas of focus today are going to be about what the effect of the corporate tax rate will be on US corporate behavior, both focusing on what it means for the domestic corporate tax and for pass-through changes, but also what it means for multinationals. We'll be talking about how firms will be using some of the repatriated capital once it starts returning to the United States. We'll be talking about, now that there's a shift happening to the territorial system, what kind of challenges and opportunities does that create for foreign firms? And then how's the rest of the world going to respond to all of that? Now, of course, I'm not going to do that on my own, but I'm going to do that with a team of experts of the Conference Board and two external presenters, which I will introduce to you in a minute. But before that, just a few remarks on how you can optimally benefit from this webcast and how to participate. First of all, this is an interactive webcast, so we really want you to ask questions, and you can do that throughout the webcast. You can do that via the chat box at the bottom left panel of your screen. Put in your questions anytime during the webcast. We will pick them up during the course of the webcast and try to weave them into the conversation. There are a couple of slides. If you want to download those, you can do that via the download pod in the bottom center of your screen. If you want to view the video or the PPT screen in full, then you can do that by clicking on the four arrows at the top right of the screen. At the end of the webcast, we always ask for a brief evaluation. It's only going to take you 1, maybe 2 minutes at very most. It helps us to incorporate your feedback into future programs. And finally, of course, we will be sharing this program on demand, so you can share it then with your colleagues, and we will make that available about 48 hours after the webcast. Finally, some of you will be attending this webcast in order to earn CPE credits, and you can do that. You have then to type in your full name and address in the space that's going to be provided to you during the webcast. You have to click OK during free pop-ups that occur during the program. You have to, of course, to stay online during the whole webcast, and it is, of course, only available for those of you who are participating live in this webcast. So with that, let me now go on and introduce the panel to you. As I said, we have experts from the Conference Board, 3 of them today. First of all, in our studio in New York, we have Brian Shaitkin, who is our senior economist. Brian, welcome for joining us and sharing with you your experience on the impact on the US economy.
Thank you, Bart.
And then we have in our studio in Washington at the Committee for Economic Development, Joe Minerick. Joe is the research director, an expert on tax policy and fiscal policy in general in the US, and he's joining us from Washington. Good to have you on, Joe.
Good to be here.
And also here in Brussels, but not in the studio, we have Ilaria Maselli. She's calling in from elsewhere in Brussels, and she's our senior economist for Europe to share some of the international and European experiences with us. Hi, Ilaria.
Hello, everyone.
And then we go to 2 of our external speakers. We always benefit enormously from having external speakers on our webcast, and today we have 2 excellent speakers. First of all, we have Michael Mundaka. Michael is the Director of National Tax at Ernst & Young. I presume calling in from Washington. Welcome, Michael.
That's right. Thanks, Bart.
Good to have you on. And finally, last but not least, we have Bill Gill. Bill is the Chair in Federal Economic Policy at the Brookings Institution, also calling in from Washington. Welcome.
Good morning. Thank you.
Great. All right. As always, what we're going to do first is we're going to start with talking about the domestic effects. Well, in the second half of the webcast, we'll talk more about the international effects. But the first thing we would like to do is to put a question to you, a poll question, so you can participate in this question. The team is going to pull up that question for you right now. And the question will be what the new tax Act has so far done on your company's operating plan for 2018? So that's the question that I think should be coming up right now. The impact of the new tax plan has so far influenced our company's operating plan in 2018 as followed. A planned acceleration in investment, no changes in your investment plan, still not quite clear where this is going, or there are effects but are more likely to be seen only in 2009. And everybody already start responding, which is great. And we'll leave the line open for about another 5 seconds, and then we'll ask each of the panel members very quickly for a 30 seconds response, sort of first reaction. And we're going to close the line now. 5, 4, 3, it's closed already, there you go. And interesting outcome, half of you are saying it's not yet clear. It's still early days to understand how this is going to impact your operating plan. There's about exactly a 50-50 distribution between those who say there's a planned acceleration in investment going to happen in 2018. Another 20% are saying that's more likely only to be seen after 2019. And then there's about 9%, so only a few, who are actually saying, I don't really foresee that there's any change going to happen. So Brian, let's start with you right away. 30 seconds, first response. Is that what you expected?
That's exactly what I expected. The Tax Cuts and Jobs Act is a revolutionary change to the system by which U.S. corporations are taxed, both in terms of domestic taxes and in terms of international profits as well, for reasons that we'll get into. And when you think about all the changes this implies in terms of the balance between equity and debt financing, the types of capital and investment projects that may be incented, it's not surprising that firms are having some trouble grappling with this and will have to assess how some key provisions play out before they can make firm decisions about how to change investment behavior.
Very good. Michael, first response to this. Sensible reaction, is that what you hear also your client saying?
Yeah, it's consistent with what I'm hearing. As Brian said, this is a big change to the tax system, so it's not really surprising. It's taking companies some time to figure out what the effects might be or should be on their investment plans. I would add to what Brian said that this law, in addition to being a fundamental shift in how the U.S. taxes corporate profits, business profits in general, with some changes as well on the individual side, many of the provisions in this bill are novel and complex, and that adds to the time that companies have to figure out what the effects are and what the responses should be.
Right. Bill, any surprises to you?
No, I was going to emphasize the point that Michael made at the end, that not just that these changes are big, but that they're novel. We've never had a beat provision. We've never had a guilty provision. We've never had we've had stuff like FDII, but I think the right response for most firms would be to try to absorb what the impact is, what the options are. It doesn't surprise me that it's unclear for about half the firms, and that effects are more likely in the future than right now. There's just a lot of information to absorb, and I think people are still absorbing it.
Very good. Ilaria, from a European perspective, is this seen as a big game changer for the United States?
Well, I think this has to be clarified yet, but I was going to put my bet on answer D, because I thought, well, investment is it's not like pushing a button, and it takes time to analyze and calculate, make risk analysis, etc. And multinationals are sometimes slower than people think. So I'm a little bit surprised of the result, and D would have been my prediction.
Okay, Joe, let's go to you. Let you start with responding to this, but then I'd so like you to continue a little bit, to talk a little bit, just get us a little bit up to date. What are the key positions in this tax plan? And can you do it in a few minutes? This is complex, so how can you best summarize this?
Well, I'd first of all agree with my colleagues, but I'll be a little bit nasty about the legislative process. This bill was passed very quickly. It was not handled in public hearings. As a result, the fact that it's highly complex is compounded by the fact that it really was sprung on the business community in in a very sudden way. So the fact that business leaders are trying to figure out the meaning of it all, to me, is quite to be expected. Let me move on and as you suggested, Bart, and talk about some of the major provisions in the legislation. We do have, and I'll focus on those that are important to business because otherwise we can go on forever. An important part of the motivation of the law was reducing marginal tax rates for individuals. It's done in a relatively complex and not perfectly transparent way. And in addition, those rate reductions are scheduled to expire after 2025. And even the most earnest advocates of the law do not believe that part of the law. It's highly unlikely that those tax rate reductions will be allowed to expire. So we're probably looking at a cost of about $1.5 trillion, which is equal to the total that the law was initially intended to consume. Talk a little bit about the effects on the U.S. housing market. There are limits on the high-end mortgage deduction, $750,000 cap on the amount of debt, the mortgage interest on which is deductible. Home equity loans, which are popular in the United States, are not deductible. At the low end, there's a big increase in the standard deduction, which means that folks who have relatively modest incomes or buying relatively modest houses may not find that there's enough mortgage interest to deduct for them actually to itemize it, which means that the incentive to purchase homes is going to be less. A big corporate rate reduction. The president wanted a 20% corporate rate. What we got instead was 21%. But that provision of the law does not expire. That's not sunset. And that's going to cost another $1.3 trillion. So it's very expensive. We're liberalizing the expensing of business, a significant of business investment. A significant amount of business tangible investment has been deductible, but there's a bigger provision in the law. It's supposed to be sunset after 2022, to which I can only say, really? It's almost as unbelievable that the expensing provision will be allowed to expire as it was that the tax rate reductions would be. And that's a relatively expensive provision. Because of it, we have to have a limit on net interest deductions. And that is another provision here that's going to be, businesses are going to have to learn how it's going to impact them. There's a 20% deduction for pass-through businesses, businesses that are not public corporations. That was another thing that the president wanted very seriously. It also is stated to sunset after 2025, and I don't believe that for a minute. There is a forced repatriation of foreign earnings of U.S. corporations, an 8% rate for physical investments that have taken place overseas, 15.5% rate for what you'd say cash being held overseas, and thereafter, foreign earnings of U.S. corporations, multinationals, will not be taxed in the U.S., but, and this is another very complex provision in the law that's going to have some very important implications, there is a minimum tax on foreign earnings of corporations, so that, as I think we all expected, this law is not an open invitation to U.S. multinational firms to move any earnings they want overseas. Some people probably expected that, but that was not going to happen, and it didn't. And this minimum tax is the important reason why.
So Joe, this is a huge deal, as you say. Also, from a fiscal perspective, we won't talk too long about this, but just give us a little bit of a sense. My understanding is that the deficit in the U.S. is now going to double in about three years' time. And if all of this gets extended, as you are in a way predicting, then it would double again in the course of the 2020s. Is that correct?
That's correct, Bart. I think there's a principle that's worth discussing here very briefly. Initial conditions matter. I could imagine what people would agree would be a potentially beneficial change in the tax law that would cost money. That if the United States were starting from a low debt and a low sustainable level of budget deficit, we'd all say, yeah, let's do it because it would have potentially good effects on the economy. The same change in the tax law might not be attractive starting from a high debt platform, and that's where we are. That's a worry.
Right. Michael, what are the business responses here? We now sort of, as you already said earlier yourself, this is a big deal. Some of this is we have not seen before, so we have to sort of figure out how is it going to work. What are some of the key business responses that you're currently seeing that need some clarification?
I break them down to a couple of different categories. As Joe mentioned, there's a new deduction for flow-through income. That is business income earned through partnerships, S corporations, sole proprietorships. A lot of businesses are coming to terms with that to see what of their income may be eligible for this 20% deduction. There is a huge carve-out in businesses eligible for that deduction for businesses that provide services. They, in general, are not eligible for this deduction. So on the flow-through side, which in the U.S. accounts for about half of the business income earned, those businesses are coming to terms with whether or not they're eligible for the deduction. And then, as Joe mentioned, on the corporate side, really fundamental changes both with respect to the rates and the international provisions. On the rate side, we are seeing now some companies trying to figure out what to do with their profile between domestic business and international business, given the changes on the international side and these new lower rates on the U.S. domestic side. Where should they locate investments and opportunities? Should they be overseas or should they be here? And in addition to that, we now have, as Joe mentioned, a potentially new source of tax-favored funding for those investments in terms of overseas cash and earnings that have been accumulated in the past and that are going to be earned going forward. Those now can be put to use here in the United States with no additional tax arising from the use in the United States, when previously, if you had repatriated earnings and invested here in the United States, that would give rise to a tax here in the United States with respect to those earnings. So all those changes have led to fundamental questions being asked. And as we've talked about, not every company has figured out every possible response. But just some of the highlights. A lot of companies looking at their supply chains, that is where they buy, where they sell, where activities are located, looking at the activities that give rise to value, intangible assets, should they be located here or abroad, as well as the activities giving rise to those assets, research and development. Does it make more sense to have those activities here or overseas? And these are very complex decisions that have both business and tax implications, and a lot of businesses that I've been speaking to are struggling to balance the changes to the tax system as well as the changes that may be required to their business processes as a result of this. And then adding to all of this, as we've discussed, the law is somewhat unclear in many important respects. Guidance will have to be issued by the IRS and Treasury Department to make some of the rules more clear, and companies are trying to decide, do they wait for that clarity or do they move ahead at this point? And then one final issue we haven't discussed yet, what's unknown at this point is how other countries are going to respond to this. Again, these fundamental changes to the incentives for investing here or abroad are being looked at overseas. Some countries have looked at the incentives now for exports that the U.S. system provides and are thinking that potentially they may violate our tax and trade agreements, and companies have to consider those responses as well when they consider what they're going to do in response to these U.S. changes.
Yeah, and indeed we'll pick that issue of the international effects up in the second part of this webcast, but let's stick for the moment, Brian, and I'll also ask Bill about this later, a little bit on what are the effects of this on the U.S. economy. So when I hear Joe and Michael it's like, it's all so uncertain. Is there anything that we can really expect in 2018 to impact on the economy, Brian?
Well, let's first look at how are these tax cuts distributed on the domestic side in 2018. So we're seeing that for the pass-through and the individual tax cuts, those are going to be implemented in stages over the next 2 years. Importantly, the corporate tax cut is going to be fully implemented in 2018, along with the full expensing provisions. Initially, the Senate bill had specified that corporate tax rates might only fall in 2019 as a means of staying under the $1.5 trillion budget limits. That went away during the conference process. So as a result, you don't have that incentive to book investment in 2018, which can be written off, and then being able to earn under that lower rate in 2019. So that's why companies have the ability to sort of take their time, because they don't have to rush in quite as fast in terms of thinking about getting investments booked in 2018. Moving forward, how are different classes of investment going to be treated? And I think the key thing to keep in mind, and what this chart shows, is the effective 2017 tax rate on different categories of investment. That's the baseline, that's the blue bars. And then the Tax Cuts and Jobs Act rates, which not only reflect the movement from a 35 to 21% baseline corporate rate, but also reflect some of the expensing provisions. So for example, with equipment, previously there was a 50% bonus depreciation. You could depreciate 50% of the cost of new equipment upfront, even though that equipment would have a useful life of about 5 to 7 years on average. Now that depreciation can be fully expensed right up front, so you'll be able to deduct the full cost, and that's why you'll see a cost reduction from about 8% to around 2%. Importantly, this provision, and getting back to some of Joe's points, expires after 2022. So unless that full expensing is extended, financing equipment investment is going to become considerably more expensive over time. Structures is where you see the largest decline in terms of the cost of financing, simply because there is no upfront deductions in the same way that there is for equipment. And so this plan heavily incents structures. And when we're thinking about long-term productivity, certainly the fact that this will finance the construction of data centers and warehouses, that's definitely a boon for productivity. On the other hand, when we think about research and development, that has been fully expensable in the past. So the value of that full expensing is going to decline as a result of these lower corporate rates. And as Jonathan Haskell and Stian Westlake say in their excellent book, Capitalism Without Capital, these R&D investments, which of course are critical in terms of helping firms grapple with the new digital economy, they're subject to some features that make them more difficult to finance. They're riskier because they can't be salvaged if they go wrong. There are spillovers which allow other firms to potentially benefit from them. So they're more difficult to finance. And so I think the fact that this plan does favor structures and equipment over R&D may have some interesting impacts in terms of thinking about what does this tax plan mean in terms of the long-term productivity growth for the U.S. economy.
So, Bill, I'm still a little bit puzzled about the complexity of this, the fact that firms are struggling with this, but that still, and then Brian explained this very well, we're still seeing, certainly on the investment side, on the tangible investment side, some significant effects happening in 2018. How do I bring these kind of two pieces together? Bill,
Bart,
can we hear you? Yeah.
Bart, I'd suggest that part of the answer to that is that for a U.S. firm, talking about a U.S. physical investment, some of the changes are relatively straightforward. It's where you go across national boundaries that I think you have much of the uncertainty in the business community about how these things are actually going to work.
Right, but I think even issues around the pass-through rates and so on, which you briefly addressed, are still sort of unclear. But it seems that for you that it will all play itself out over the next few months.
But I think the pass-through rate is worth talking about some more, simply because I think this is an area where companies, and Michael can speak more to this point, are struggling to figure out exactly what they're going to be able to classify as capital income and be able to benefit from the pass-through deduction. What are they going to end up having to consider as labor income and have that pass through at high individual rates? So that's going to be an incredible amount of uncertainty. I don't think the provisions were written in an incredibly clear way to guide firms in terms of grappling with that issue. And that could also mean that individuals at large corporations may end up trying to reclassify themselves as pass-through businesses if they can figure out ways of having their income be classified as capital income rather than labor income. So that could change the relationship between key employees at small and large firms and their employers.
Michael, any thoughts on this, also on the economic effects and what you expect to happen in 2018 in terms of effects versus later? So we have Michael and Bill, or we don't?
Oh, yeah. Can you hear me?
Yeah, we can hear you now. Please go ahead.
Yeah. Yeah. As Brian was saying, there are a lot of discussions going on about just how fundamental a change this is with respect to the taxation of pass-through income. It's clear in the law that a number of services are exempted from being tax favored. So if you provide services in health, law, accounting, performing arts, consulting, athletics, financial services, etc., you are not eligible for this 20% deduction. That leaves a lot of services within. So the notions are that perhaps many people who are operating now through corporate form or are employees and getting wages may set themselves up as flow-through entities and have the entity hired to provide these services, and perhaps then, if this works, get the benefit of this 20% deduction. If that planning works, this could be a fundamental shift in how employees classify themselves for purposes of this new tax law. Now, again, it's complicated and not entirely clear whether that sort of planning might work. There was some discussion at the time the bill was being passed that such changes in their classification from an employee to an independent contractor, et cetera, might not be something that the law anticipated happening. But we have yet to see guidance on this. But again, it is something that people are discussing. And as we see the economic trend of more people entering the so-called gig economy, this could be a spur to that, because I do think in those cases where people are more clearly independent contractors, aren't seeking to shift their relationship with their employers from one of employee to one of independent contractor, they're already classified as such. This does appear to provide a significant tax benefit that many people could seek to take advantage of going forward. So that's one element I think we have to keep in mind as people look to how this tax law may affect the economy. We could see a huge shift over time with people already looking at being independent contractors now getting a tax incentive to do so. Then obviously on the corporate side, the companies that hire them have to consider the changes in the labor markets and what the incentives might be for them on the corporate side to hire people as independent contractors versus employees. And again, this feeds into social trends and trends we're already seeing where people are moving around more, aren't necessarily linked to one employer, and we could now have a significant tax effect from having classifications as employees versus independent contractors.
All right, so let's wrap up this domestic part, and of course there are elements coming back when we talk about the international effects, but let's zoom in a little bit more on the international effects, in particular for multinationals. Many of them were on this call. That, of course, probably also the more important and relevant part. So let's start again with a poll question, and which I expect we're going to see right now, and that is really about what will the primary effect of the U.S. tax plan on the global economy be? Will it make U.S. companies more competitive relative to the rest of the world? Will it cause foreign countries to also lower their tax rates for businesses? Will it have little to no effect on global competitiveness or growth, or is it still not quite clear what this all means for the global economy? So we give you some time to think this through. U.S. companies will become more competitive. Foreign countries will lower their. Of course, there are multiple things possible, but pick the most important one here. Foreign countries lower their tax rates. It has little or no effect, or it's not yet clear. And we give it 5 seconds. 5, 4, 3, 2, 1, and we're going to close it. And what we're finding here is that actually it's quite a large group now, almost half of you are saying it's really not clear yet what this all is meaning for the global economy. There's a good group, 38%, who says, no, this will definitely make U.S. companies more competitive. And then there are a few who think, it might actually cause foreign countries to do something here, or it will have little or no effect. So again, very quickly, reactions from the group. Ilaria, let's start with you this time. Surprises here to you?
Yes and no, in the sense that, my answer would be that foreign countries would also lower the rates. But I would say, yes, it matters that there was a major tax reform in the US, but also this is a long-term trend that we observe since the last 2 decades. So I would, my answer would be consistent with the second one, but again, I'm in the minority here.
Right, and we'll come back to that a little later, why you think, what will happen in other countries here. Joe, what do you think of these poll results?
I think it's fairly predictable. I would, however, lean toward concern about a race to the bottom with respect to corporate tax rates. For many countries who are bidding not so much for physical activity as for the location of intellectual property, there is going to be a temptation to try to maintain a competitive advantage in getting firms to move their patents and whatever and trademarks to that country and attributing the income to income in that country that's taxed at a very low rate. For many of these countries, you're not talking really about financing government activity. You're talking about a source of income that is available if you're willing to bid for it. So I'd be more concerned, I think, than some about the possibility that the corporate source of tax revenue for countries trying to finance necessary activity is going to become harder and harder to tap because of a race to the bottom on corporate tax rates.
Right. Michael, what do you think? Surprised that many people really don't quite know what this is going to mean?
No, I think it's a theme of this. People are still trying to come to terms with exactly what all this means. I do think, though, at least as an initial step, the significantly lowering of the U.S. rate as well as some of the changes to the international system will make multinationals look at changing their investment profiles and perhaps favoring the U.S. So I understand why a significant portion of respondents said it makes the U.S. more competitive. Again, we've yet to see what the responses are going to be internationally. That may change that balance, but at least right now, such a significant drop in the U.S. rate, such significant increased taxation of the foreign income of U.S.-based multinationals under some of the provisions that Joe spoke about in the beginning, these so-called guilty beat, et cetera, I do think are going to lead companies to think about investing more in the U.S.
Brian, any thoughts here on the poll result?
I agree with both Michael and Joe. As intangible capital becomes more important to the global economy, you're going to see a race to the bottom in terms of tax rates. It's going to be much easier for countries to collect taxes through value-added taxes than it is going to be through corporate taxes, given the easy mobility of capital. And I think the real question is going to be, how do you create a more value-added tax-based system while not creating greater inequality in economies that try to lower corporate tax rates? I think that's going to be a very difficult challenge for policymakers to face.
So, Bill, I hope you're back with us here, and I'd like you to talk about some of the elements of the foreign part of this. So there is obviously the move towards the territorial tax system, or at least a partial move in that direction. There's the whole issue about how repatriation can impact the behavior of firms. This has been tried in the past. Can you give sort of any sort of experience that we're having with some of those trends that are in this current tax plan and what that might mean? So I think we still don't have Bill back. So Michael, I'm gonna.
Oh, I'm here.
Oh, here you are. There you go. Please.
Yeah.
Go ahead.
Yeah. Sorry, I didn't realize. I didn't hear you call my name. Repatriation is an interesting issue. I think it's widely misunderstood. In 2004, we had a temporary holiday for repatriated funds. Firms could only get the tax cut if they promised not to use the money for dividends or buybacks. Empirical evidence suggests that that's exactly what they used the money for, and so it did not. The job creation effect did not seem to be very big. Now we've got a permanent repatriation holiday, essentially, with this deemed repatriation that has to occur. It's important to understand that repatriation is not a geographic concept. The money is not literally sitting offshore in a vault in Luxembourg or something. Most of it is already invested in the U.S. economy in terms of bonds or securities. Apple, for example, in their annual report says that 90% of their unrepatriated funds are holding government securities right now. So the repatriation is essentially a legal concept. The firm has to recognize the money that it's earned before it can pay it out to shareholders, or in the past, that's the way it worked. Now, of course, firms can simply bring the money back, quote unquote, and pay out either buybacks or pay out in dividends. There's some evidence that the money is going to be used for mergers and acquisitions, in which case it could have a negative impact on overall jobs. But I don't think it's realistic to think of repatriation in any case as providing a big boost to the American economy.
And what about this move towards the territorial tax system? It's only a partial move. How's that? I mean, we don't have a lot of experience with that in the U.S., so what is that all going to mean?
Well, I think we didn't really have a worldwide system in the past. We had a very convoluted deferred system. It's not really clear to me how different the modified territorial system we now have will be. It's clear it'll be different in many different ways, the GILTI and the BEAT and the FDII provisions, for example. But we don't have a pure territorial system now. And for certain firms, I think the system is going to end up being more onerous than the previous system. For other firms, it'll be a benefit.
Michael, additional thoughts about it. How is this going to play out under this plan? Where do you see the biggest effects taking place when it comes to the role of multinationals and how it's going to impact multinationals here?
Yeah, it's a great question. And in my conversations with some of my clients, again, still trying to come to terms with these fundamental changes. As Bill mentioned, we had what was called a worldwide system before, meaning the U.S. taxed the worldwide profits of its U.S.-based multinationals, but it didn't really. There were a lot of exceptions and a lot of ways to plan around it. This new system, which is called a territorial system, actually, I think, subjects more foreign income to immediate U.S. tax with this so-called GILTI provision, which, again, looks at your income earned overseas, and this is gross simplification, but allows you a return, in essence, on your tangible assets overseas and taxes at a lower rate, the rest of the return, subjects that to immediate U.S. tax, and that was not an element of the U.S. tax system until recently. Then there's also this so-called BEAT provision, which, in essence, and this is a gross simplification, but puts significant restrictions on deductible payments made to foreign-related persons. So it really changes the analysis of a U.S. multinational's decisions with respect to the services, for example, and royalties it pays to foreign affiliates, as well as the income it earns from intangible and other assets overseas, because it does change the U.S. taxation of the deductions and the returns. And then in addition, the significant change of saying that your overseas earnings now can be more easily invested in the United States without drawing additional U.S. tax. Now, again, to Bill's point, we shouldn't overstate the effect of that. There were many ways that companies put those funds to use in the U.S. There are going to be more uses now, and I think coupled with some of the other changes in the U.S. law with respect to deductibility of interest, the real change is going to be with respect to the capital structure of corporations, their mix of debt versus equity. There will be other sources such as overseas earnings they can tap as opposed to the debt markets, and their tapping of the debt markets may be negatively impacted by the restrictions on interest deductibility. So all of these feed into each other, and the clients I'm talking to, again, are trying to come to terms with all these changes to their supply chain, their capital structure, their M&A activity, and then again, we do have as well these temporary incentives for investment in capital assets as well. It's a lot to take in, and companies are just coming to terms with it.
So let's talk a little bit about this BEAT tax, so the base erosion anti-abuse tax, because I think that is interesting. I mean, the U.S. was always a little bit distant from this. Now that they're making this move, they're actually getting, they want it to be fully implemented, and they really want to see action on this. The OECD has been arguing that this might actually be a good way to get actually the U.S. participating in this. So do you think we're going to see a real change in the way that the U.S. is approaching it? And again, what does that mean for businesses?
Yeah, this is a real change. And again, you're right that many to date thought the U.S. was perhaps not as active a participant in the OECD base erosion and profit shifting project. Well, with the implementation of this BEAT tax, the U.S. is all in. And again, what this provision does is essentially say that certain of the payments that U.S. companies make to foreign affiliates that would otherwise be deductible for U.S. purposes will now have, in essence, those deductions limited by this new regime that looks to the deductible payments, recalculates your base, applies it at a lower rate, and then you pay the overage versus your regular tax. So again, it's complicated. It's not as straightforward as a straight deduction limitation, but it does operate as such. And again, almost all payments made to foreign affiliates will be subject to this, other than for cost of goods sold. So that's not an element of this. There was an initial House provision that did have cost of goods sold in the analogous provision to the BEAT, but that's been taken out. But other payments, royalty payments, costs for services, all those are in this alternative system. And again, it does change the calculation of the tax for U.S. purposes, and does change the calculation of where to locate your investments. If you're locating them overseas but making use of them for U.S. purposes, you now have to figure out how that changes your U.S. tax liability.
Well, and particularly when it comes to these intangibles, right? So does it still make sense for American firms to keep IP rights in low tax jurisdictions like Ireland and so on?
That's right. If you're locating your intangibles overseas but using them here in the U.S., you now have to consider whether or not those payments and the deduction for which will now be limited mean that the tax implications simply no longer make that location meaningful in a tax way. And again, you also have to factor in this fundamental drop in the U.S. rate from 35 down to 21 at the federal level. So all deductions, in essence, are less valuable than they were in the past, and then you add on these limitations and they become even less so.
So, Ilaria, let's go to the other side of the pond, the European side, and we already had some discussion about the risk of a race to the bottom and the fact that, this may lead to significant adjustments in corporate tax rates in some of the European countries. I mean, the question is that just a lot of talk, or is there really something happening? And can it really be called a race to the bottom?
Answer is I don't know, but I'll try to qualify my statement. So I see three types of effects. The first one is in terms of foreign direct investment. There was a very accurate estimate by a German think tank, ZEW, and they calculated how this changes the balance of foreign direct investment between Europe and the US, and this will be in favor of the US. So there will be more, there will still be foreign direct investment from US companies into Europe, but the balance will be shifted. There will be more and more investment from European companies in the US as a result of all these changes that were passed in December. So this is a first element of my answer. So I think we can expect some changes there. Then there is another dimension, which is a dimension of profits and actually revenues in terms of state government revenues from the taxes. This is not widely discussed, and I'm a little bit surprised by that, because in 2009 there was a similar big change from a worldwide to a territorial tax system in the UK and in Japan. And if you look at the data on government revenues from corporate tax income before and after that period, you don't observe much of a change. And the little evidence that exists, because this is obviously very difficult to study, says that there is not much improvement in terms of revenues once you switch from a worldwide to a territorial tax system. So hopes there might be a little bit disappointed. But then there is another element, which is the tax competition, and this is probably the most important one when it comes to Europe. Well, as you know, in Europe, there is in the European Union there is no common corporate income tax rate or any other one actually, and there is not even a common base for taxation. And this is something the European Commission has put on the table several times, but still didn't go through to the Council. So the situation right now in Europe is that you have all possible rates going from 13% in Ireland to 35 to 34 in France, with all the countries, with all the possible scales from low taxation to high taxation. And it is well known that there is a lot of tax competition in the European Union. So having more competition on this obviously puts additional pressure on European countries. And as I was saying at the beginning, I wouldn't be surprised if any of the big countries, which you can see here right now in the chart on the screen, would be pushed to move in a similar direction. And this would be actually very much consistent with the long-term trend of the past almost 2 decades of lowering corporate tax income rates. And yes, on top of this, there is the fact that this was stressed before already by the other speakers, that when this income becomes more mobile, obviously the pressure is even higher to try to attract this type of business. So yes, I would expect some action in this direction. This could go one way, could be the further lowering down of the tax rates, or one other direction, but this I would put a very low probability attached to that, is that Europeans get together and start defining some boundaries, for example, defining a common tax base to tax income without actually touching the rate.
Right. So let's put up another poll question, because obviously there are lots of considerations why companies may ultimately decide to move operations between countries, and this poll question is trying to get to this. Of course, more favorable tax treatment could be one reason that you say, okay, I'm going to move stuff back to the US or whatever, but there can be other reasons. Labor cost advantages can be important. The benefits of technology to drive automation faster and be more productive. Access to suppliers, including shared services, can be a key reason why you're going to go to particular locations. or just, you need to be close to the customer, and the desire to serve your customer more effectively can be a reason. So again, all 5 reasons are important, but we just want to figure out how important is tax treatment relative to some of those other reasons to move business. And then I'm going to ask again the panel. This time I'll start with Bill to sort of respond to that. Where does the tax exactly fit in? So I'll give it 5 more seconds here. 5, 4, 3, 2, 1, and then we're closing this. And what we're beginning to find, we're closing it probably now. So what we are finding here is a pretty mixed view. Actually, the majority says it's really about being close to my customer. Only 1 in 5 of you are saying it's about the more favorable tax treatment. Another 1 in 5 are saying it's about a labor cost advantage, and somewhat less about benefits of technology and access to suppliers. So Bill, let's start with you. Where does tax come in when companies take business decisions, and when is that going to be dominant? And in the light of this specific tax plan, how important do you think it's going to be relative to these other factors?
Well, I think from a policy perspective, it highlights the notion that taxes matter, but they're not the be all and end all of existence the way they sometimes get portrayed in the debate. Then they raise the broader question, I think, of will other countries let the U.S. be a low tax country? We certainly have some advantages in terms of desiring to serve customers more directly, access to suppliers, benefits of technology. Maybe we don't in labor cost advantage, but there's a lot of advantages that we have relative to other countries. And harking back on the earlier discussion, it will be interesting to see if other countries let the U.S. be a relatively low tax jurisdiction, or if they respond more aggressively, either through tax rates or patent boxes or base erosion generally. I think that's a big uncertainty regarding the recent Tax Act.
Brian, how do you view the responses? Vary a lot, obviously highly dependent on what kind of business you are, what kind of industry you're in, but where does the tax thing fit in your view?
I think it's very important to recognize that for different industries, the importance of different types of location decisions is going to be vastly different. How important is it to be located near exceptional talent? How important are given geographic features? How important is tax financing relative to other types of considerations? And I think what we've learned on this program is it's not just a matter of the tax rates that's going to determine firm behavior. It's also all of the new regulations around it. I think one thing to keep in mind, as Michael said earlier, is that this plan heavily increases the desirability of equity financing by reducing the deductibility of interest rate costs. It makes debt financing more difficult to access. And depending on what European countries do, if they end up lowering rates, that's going to mean less debt financing in the US. That's also going to mean that companies that are receiving repatriated money, or those large multinational firms, they're going to have cash. They're going to be in a unique position to finance M&As, whereas other US firms that may be experiencing higher debt loads and interest rate payments, they are going to have more trouble. They're going to see valuations fall. So this may set up a scenario where a lot of that repatriated capital ends up being used in an MAA context, and that could lead to further consolidation for the US economy. Whether that's good or bad for productivity, I think is in the eye of the beholder.
Right, okay. So I'm going to use the last 2 minutes or so for basically asking a question to each of the panel members. And the question is actually quite simple, but it gives you a chance to make some wrap-up comments. So overall, do you think that the US tax plan as we're having now will be a good thing for the global economy in the medium term? So do you think in the end we're going to benefit from all this, or do you think in the end it's not going to make some difference? And as I said, it will give you an opportunity to make some wrap-up comments also on what we've learned from this webcast. And Joe, let me start with you.
Well, I think it depends on where you're looking. In terms of the U.S. economy, we're spending $1.5 trillion largely on business tax reduction, you would hope we would get something from that. But on the other hand, the U.S. fiscal situation was perilous before, and now it's going to be worse. And I think looking forward, the balance between the benefits that you get from reduced taxation of business in this particularly non-transparent, uncertain way have to be weighed against the fiscal side. In terms of the world reaction, I'm sure that there's going to be some tax rate retaliation from other countries. Is the world better off if businesses relocate for a while to the United States? Not clear. If the U.S. fiscal situation really does become troubling, what is the benefit of that for the world economy? Clearly not much. So it's interesting. You see a lot of motion up and a lot of motion down. It's not clear what the net is going to be.
Okay, Michael, where do you come out on balance?
Well, I'll hedge my answer. I think short to medium term, it's hard to see how this couldn't lead to economic growth in the U.S. and therefore globally, because as Joe said, this is an injection of an enormous amount of money into business. We have 1.5 trillion. That's the static cost of this tax bill. It is front-loaded, as Joe went through, because a number of things expire. We also have a recent budget deal in the U.S. that put about another $500 billion of money into the economy over the next 2 years. So I do think we'll see short-term growth. Medium term, it becomes a bit more cloudy, and long term, very cloudy, as some of these economic effects from having this increased U.S. debt, unless we get extraordinary growth that's not being predicted by any economists that I've seen, put this to a reputable model. So I do think short to medium term, yes, I would expect growth. Longer term, we may see some negative effects from the increase in the U.S. debt, crowding out business investment, raising interest rates, et cetera. But I think short term, hard to see how this doesn't lead to growth.
Bill, do you find yourself on the optimistic or the pessimistic side of this question?
I'm on the pessimistic side. This is a big tax cut at a time we didn't need it. It's a regressive tax cut at a time where income inequality and mobility issues have gotten significantly worse over the last 30 years. There, I think, are some good aspects of this on the business side, but they didn't do the hard work of closing tax expenditures. They could have gotten the rate, to 25 with modified territorial on a revenue neutral basis if the bill hadn't been so stuffed with political favoritism and so rushed through the process. The pass-through provisions are just utterly ridiculous and without redeeming virtue. I just feel like they could. I feel like if you stuck the bunch of economists on this call in a room, we could have come up with a package that had better incentives, was fairer, and cost less.
Yeah. Ilaria, should European businesses be really, really worried, or should I see it as an opportunity?
No, I'm also on the pessimistic side, and I thought I was the only one, not only as a European, but also in terms of global economy, because the global economy is now growing above its potential, and this reform comes at a moment in which it's very procyclical, and I think that's not what fiscal policy should do. So I'm worried about the way we're going to pay back for this.
Brian, the Conference Board, our forecast adds another 0.3% to GDP growth in 2018. Do you think that will be continued in the years after that?
I agree with Ilaria and the other panelists. In the short term, there's more spending, even though the economy is running strongly. That's going to mean more growth. However, the question is, this plan spends a lot of money. Was that money spent in an optimal way that will make the U.S. economy stronger over the medium and long term, which has benefits both for the U.S. and global economy? I don't necessarily think that's the case. I think that there is a real case to be made that certain types of infrastructure spending could have been more beneficial. I think it's especially troublesome to be spending this kind of money during a time when the economy is already running strongly, so you don't get as much bang for the buck in the short term. So for both of those reasons, I think short term, it does add to growth, but over the long term, this is not the best way $1.5 trillion could have been spent.
Great. So what I take away from this, a lot of hard work to do for businesses to figure this out, but we're optimistic to actually get something in the next year or in the current year, and maybe in 2019, but down the road there are many, many questions about how this is, and there are a lot of other things you need to do as a business in order to be able to sustain growth going forward. Panel members, thank you very much. This is extremely interesting, a lot of content pumped into 1 hour. This ends the window on the US tax plan, at least for now. Next month, we're going to talk about a completely different issue. We put a window on Saudi Arabia and the economic and business challenges in that part of the world. We'll have more speakers joining us, but we already have made a start. So we hope to see you there again. And then finally, as I said earlier, we always like to hear from you on how you can benefit from this webcast and any future topics that you're thinking about. We absolutely want to hear from you. Thank you for joining us. Thank you again for the panel members, and hope to see you again soon. I'm Bart van Ark, Chief Economist at the Conference Board.